Good morning and welcome to the latest edition of What's Up Monday. This is Dominic Chirichella from Energy Management Institute, now a division of DTN. Today we're going to talk about what's happening in the oil markets, what's happened last week. As we talked about in last week's What's Up Monday, it was expected to be a very, very interesting week, and it certainly was a very, very, very interesting week. And the highlight of the week, without a doubt, was the OPEC meeting. And that is actually something I'm going to spend more of my time on in this version of What's Up Monday, because it is going to have the most important or the most significant impact to the short term and probably the medium term direction of oil prices. So with that, let's dive right into it. Again, as usual, if you have any questions, you can reach me at dominic.chiricheller@dtn.com, and I'd be happy to answer any of your questions. So with that, let's get started and let's talk about what's transpired and what is expected to transpire. As of now, most everybody knows that the OPEC, non-OPEC production adjustment, let's call it an adjustment, because the original agreement is still in place. And basically, what they did was to throttle back everybody who's overcutting, if you can believe that. My goodness gracious, if we go back in time in history, that was just the opposite situation used to exist, where OPEC countries used to basically just cheat and operate at a low level of compliance. Due to unforeseen circumstances in 3 or 4 countries within OPEC, coupled with a desire to push prices higher, this entire deal has operated in an area of over compliance. In May, the compliance level was about 160 to 165%. So we're going to dig into this deal in much more detail, starting with the next slide. And obviously, we're going to talk about the fundamentals and the volatility and the external markets. We'll touch on the geopolitical risk as we're talking about OPEC. Obviously, the single biggest thing impacting the equity market is the potential for a trade war. The idea of runaway inflation and central banks around the world raising interest rate at an exceptionally quick rate has kind of moved into the back burner with the trade wars or potential trade wars between China and the United States and United States and Europe. Just this morning, basically, there's word that the U.S. is now preparing some sort of restrictions on ownership, Chinese ownership in technology companies within the United States, and also some restrictions on exports of technology from the United States. So equity markets around the world are lower, and that's acting as a little bit of a potential negative for oil prices. On the other hand, the dollar is slightly lower, and that's actually obviously acting as a slight positive for oil prices. So we'll talk a little bit about the price direction. We'll highlight just a couple of spreads this week, and those more related to the OPEC deal. And as I said, the equities and the dollar have been a mixed driver for oil prices over the last week and even starting this morning. Just quickly as a look at last week, up until Friday, when OPEC actually announced that they were going to reduce compliance down to 100%, oil prices were lower, and we saw the push we got on Friday sent prices higher across the board. The biggest loser on the week was the Brent WTI spread. And again, I'm probably going to say this several times as I get through this presentation, is the Brent contract was impacted much more so than the WTI contract, because as OPEC increases production, that's more crude coming into the international arena. That tends to have a negative impact on Brent and crude oils that are indexed against Brent. So again, we saw that spread really narrow. It's actually narrowing again this morning, and as we speak, it's trading at around the Augie Brent WTI spread's trading about 5.30 a barrel. If you remember back in mid-May or so, I believe it was mid-May, the spread actually got up to over $11 a barrel. So we're about half of where we were back then, maybe even a little more, a little less than half of where we were back then. The economics to export crude oil from the United States are still solid, except the windfall that some companies were getting because of the $11 spread, the $10 spread, the $9 spread. That's kind of fading into the sunset at the moment. So where are we as of this morning, as of around a little after 8 a.m. Eastern time? We're starting to see a little bit of a kind of a relook at Friday's activity. Brent, WTI were strongly higher. On Friday, we're getting a bit of a retracement. We're off the lows. We were much lower in Brent early on this morning, 5, 6 o'clock in the morning Eastern time. And actually, WTI was also negative about 20, 25 cents a barrel. That's kind of flipped around a little bit. And again, what we're seeing is the biggest loser on the oil side, again, being the Brent WTI spread. And that's trading at around 550 a barrel or 530 a barrel just a few minutes ago, as an update to that. Refined product prices are lower. They're pretty much following what's going on in crude. Refined product prices are not leading the oil complex right now. Crude oil is leading the direction of the oil complex, and I believe it will so for the short to medium term. For those following natural gas, the weather looks like it may be cooling, especially along the western half of the United States over the next week or so, and that could then spread across the country. So the exceptionally warm, above normal temperatures, kind of a little bit of a warning sign coming across in the weekend forecast that came out. Right now, as I said before, the equities market is lower. The equity markets are lower. We're lower around the world today. And again, it's primarily because of this new initiative that's being talked about of the limitation on technology companies and exporting of technology from the United States. Dollar's a little bit higher, and that's a little bit of a positive for oil prices right now. So let's get to the OPEC deal, because that's what it's all about. OPEC formally agreed to increase production on Friday, and it was a pretty quick meeting. Saudi Arabia started talking about mid last week. We need to increase production about 1 million barrels a day. As I've mentioned many times in this venue and in my daily publications, usually what Saudi Arabia wants, Saudi Arabia gets, and lo and behold, what Saudi Arabia wanted, Saudi Arabia got. Everybody kind of came into the consensus, even Iran, who was backed down from wanting to have some negative comments toward the United States in the official communique. That went by the wayside. And basically, I think the main catalyst for getting a consensus was it wasn't a formal volume increase. Rather, it was a return to compliance increase. So nowhere in the agreement did it say, Saudi Arabia is going to increase production by X and Kuwait's going to increase production by Y. It basically said everybody should return to 100% compliance in May. Compliance was around the 160, 165, 165% level. And we know, and we'll talk a little bit about more as we evolve through this session, we know several countries can't come back to compliance. So by doing it this way, it was kind of a everybody saving face type of a deal. It didn't say the Saudi Arabia was going to take market share away from those countries, but it did not say it wasn't. So again, it left everybody with the opportunity to go back to their home countries and say, yeah, we won. We got what we wanted. On Saturday, the non-OPEC countries, and really the main one we really talk about is Russia, they agreed to the same increase. Russia should be increasing production. It'll translate to about 200,000 barrels a day over the course of this year. It doesn't look like Russia's going to be able to increase immediately, but we'll see. So again, the agreements were 100% compliance to the 2016 production cutting accord, and this will eliminate all of the overcompliance, assuming that everybody was able to go to 100%. They can't. So we'll have to see how this thing all plays out as we evolve. This is going to be very, very critical insofar as how individual OPEC countries react to each other, as well as how the market reacts to what evolves as we start seeing production coming in. And again, as I said, the exact volume targets per participant have not been set forth. They're not in concrete. It's a compliance percentage. Basically the numbers, depending on who calculates them, how you calculate them, where you start from, could be anywhere from 700 to 1,000 barrels a day to 1 million barrels a day, including the non-OPEC producers like Russia. I thank you for spending time. Please join us and take a trial. We're offering a 4-week trial to our publication. You can go to that website there. If you have any questions or like to email me on any topics related to my presentation, it's dominic.churchiller@dtn.com. Keep your seatbelts fastened and expect a lot of volatility, especially short term, a lot of intraday volatility. There's still going to be a lot of 30-second news snippets hitting the market, whether it be OPEC related, whether it be trade war related, whether it's coming from the United States, whether it's coming from China or Europe. There's just a lot of things that are going on right now that the net result is it's just increasing the volatility in just about every single asset class that's traded out there in the market. So good luck trading, and I hope you have a successful week. Thank you.